There's no doubt that there's a lot of noise in the real estate market as it pertains to supply and demand driven by high interest rates and low inventory. So whether you're a first-time home buyer, a builder, maybe an investor, or even a baby boomer thinking about downsizing like my parents, you're probably wondering how this is going to impact you, your life, and your family. So today we are taking a deep dive into what's going on in Lafayette's real estate market with our very special guest, Mr. Bill Bacque. Bill is Acadian's real estate data guru. He's got over 40 years of experience, and I personally share a lot of the same values as he does when it comes to looking at the data and how we give advice to our clients and our partners. Mr. Bill has been my mentor for many years, and I'm excited to dive into what's going on in the real estate market and give you all of the data that you need to navigate our current market. All right, so Mr. Bill, thank you. As always, it's such an honor to have you really break down the numbers. And today, I was thinking about our listeners, and I really wanted to try to add as much value as possible. So some context before we get into the content and the supporting numbers. And there's so much noise out there right now about, higher interest rates or fluctuations in interest rates. We've got, low supply, right now in some price ranges, higher prices on average and lower demand. So, if you're, looking at the different types of demographics that are coming into the market, as a buyer or a seller, or sometimes both, they have to sell to buy. And then you have the, so the other demographics like the baby boomers, like my parents, and the conversations. I mean, just in the last 7 days, I've had, a dozen conversations with buyers about, hey, is now a good time to sell our house and buy, or should we renovate and stay where we are because we're at a low interest rate? So let's just start there. Let's say, thinking about what's happening, the news that's out there. If you are somebody out there thinking about getting into the market, from selling a current home and moving into a new home, what would be going through your mind right now when you're analyzing this about your situation, if you're in that situation?
Well, as you started out by describing it, Jim, there's a lot of noise out there. And so it's understandable for people to be hearing that noise. Newspapers, however you get it, you're getting a lot of information about things that concern people nationally. We have banking problems. We have interest rate problems. We have inflation problems. And then you're hearing, certainly from the talking heads nationally, about housing being problematic because of the cycle that we've been through over the last 3 years. The reality is there's a lot out there that if you want to be a pessimist, you can be a pessimist about. There's not quite a lot out there for you to be an optimist about, but there are some optimistic things that are going on, and I hope we can get into talking about that. And then there's the reality, like I call it, informed reality, that is the real ground that we need to be standing on. And that's what I think is missing in our dialogue. We're either way out on the right side hearing this noise, or we're on the left side hearing this, and I'm not meaning right and left politically, you're just hearing it. And sometimes, and actually most times, reality or truth is somewhere in between. And so when we look at our market in Acadiana, there are some very positive things in my mind that we can look at. One is the trajectory of demand. That is, we started out in January with some really, really low numbers, and February, the trajectory was this way, and March was this way. So if you were to take these 3 months in isolation and just put the arrow of where the market is going, and you showed that, people would go, wow, this has been a pretty good first quarter. Right. And in reality, it has. The only problem, though, is that we're using as a comparison last year.
Yeah.
And last year was part of this fictional market that was created in 2020, 2021, and then it started to readjust in 2022. We lost basically all of the gains in 2021 were erased in 2022. And what we're working on now is 2021's, which was the beginning of this. Right. And what I pointed out and what I found really interesting is that the overall decline from the first quarter of last year was 30%. We had predicted the beginning of this year that the overall decline in our marketplace was going to be somewhere between 10 and 14% because we'd given up last year half of our gains, and we were going to get down to 2018, 2019 levels. Well, 10%, 10 to 12% decline was what we predicted. We saw a 30% decline in the first quarter, and people came to me and said, well, Bill, how in the world can you be uplifted or optimistic about the numbers that we're seeing? It's 30% below last year. And I said, because 2022, although it was a correction year, it didn't start correcting until after the first quarter. And so actually the first quarter of 2022 was the highest first quarter we ever had because the adjustment in the marketplace started coming in after March. And so when you calculate that in, where we are by looking at quarters, we're actually about 2% off of the average of 2018, 2019, which is exactly where we predicted we would be. And we have a trajectory that's moving upward. When last year, after this month, the trajectory began going down, I believe that we're going to be on track, certainly by mid-year, to be looking at where we were in the average of 2018, 2019. And maybe, if some positive things continue to happen, we may even see that narrowing a bit and maybe be a little bit above the 2018, 2019 average. So, I mean, you can call me a Pollyanna for being somewhat optimistic. I would rather label it as being a realist who's just looking at things from a realistic standpoint.
Well, and just to support what you just said, like we talked last month in February, and we were closer to 45% off.
Absolutely.
So we're going to see that it go from 45. January was almost 50.
Right.
Then 45. Then now we're finishing the quarter 35% below where we were last year, but still above in volume in 2019.
Right.
Because our sales are still a little down. But as we move throughout 2023, we're going to see that comparison start to, that first part of 2022, the impact of that's going to be less and less when we're comparing it year over year. But we all knew when that was happening, you told us multiple times, this is not going to last. I mean, it was an anomaly the last, during the pandemic, driven by low interest rates, but that leads us to what you just said. The reality is, we are not in the same place that we were. It's a different market, but it doesn't necessarily mean like what I found is this. I've had probably 6 or 7 conversations just in the last 15 days about people wondering, hey Jim, should I? We need more space. We need to make this move. Should we put our house up for sale? Or should we renovate, or should we buy a new house?
Sure.
And everybody's situation is a little bit different, but it goes back to what you were saying earlier, which I want to talk more about. It should be that conversation. If you're having that conversation, should really go back to your situation as far as equity, when you bought, how much equity you have to make that move happen.
And the other thing we have to also keep in mind is when we're talking about housing, for the most part, excluding the investor class, housing is housing. That you your principal motivating factor for buying a house is because it suits your needs and wants, as opposed to it being solely an economic decision. So what we're hearing is really only half of the I don't want to say argument, but the justification for ownership is the concern right now. Jim, is this the right time to buy or sell? That's an economic question. Okay. I would follow that up is what's happening in your life, because what is happening in your life may overshadow the economic impact. Okay. You need space. You got a job offer somewhere. You got to sell, to take advantage of that opportunity. There's all kinds of variables that go into play that are simply more than just based on the economies. But if we look at the economies, some of the correction in the marketplace that we both talked about, I described, and everyone else has described it as an anomaly market. And once we're beyond that, what are we getting back to is a more balanced market. A more balanced market between inventory and buyers, meaning that selection is now a little bit greater on the existing stock of listings, not so much because there's an overflow of listings coming into the market. It's just the opposite. Listings are down. It is the drop in demand beyond that crazy level that's now allowed the shrinking inventory to at least catch a breath.
Rebound.
A little bit.
Yeah.
And so when we look at those number of months supply of product, and I pointed this out this week when I made a presentation at the Light Center, that our number of months supply of product overall through the first quarter is 3.6 months.
Page is that?
That's page, 43.
See.
3.6 months, okay? And notice that's up from 1.6 months last year.
Right.
Now, and then you see at the bottom, the active listings are up actually about 55%. Now, this is all of Acadiana, okay? So what's happened? We've had new listings declining, but we've had the inventory increasing, and that's a direct result of the fact that we've had a lowering of demand to realistic levels. Now, this 3.6 months, as you and I both know, that's not an oversupplied market. It's not even close to being one in balance. 6 months is the balance, 5-6 months. So we still have some way to go, but it is still an indicator that if I'm a buyer and I'm wanting to start looking at property, you pointed out, this may not be a bad time to start looking, because there are more and more opportunities to fall in love with the house that's out there that meets your needs than there was just a year ago.
And every price range is different. You know, if you look at each price range and have a different amount of supply, we know there are certain price ranges where there is oversupply.
Absolutely.
Currently right now. So, you know, if you are a buyer who, you know, tried to come into the market in 2021, 2022, and we had a lot of clients like this, they decided, you know what, it's too competitive. We're not going to find the house we want for our family. We're not going to make a move.
Right.
And we do have people like that. Now they're starting to come say, hey, look, is there more inventory? We're having those conversations because some people don't even know, you know, what is really truly happening. Like you have some people who I've had conversations where they literally think the world is coming to an end and the real estate is we're in a bubble and it's all crashing.
Right.
But then the facts is, you know, that's not what's really happening. Yes, we are down compared to the anomaly years, but we're actually on track. If you were to look at the long-term average numbers of the last decade, we're right in line with where we should be ending the first quarter.
Absolutely. And if you would, you know, if we could all say, gee, if we could have just taken away those COVID years and all the discombobulation that it caused our lives in so many ways, if we could just take those back, we'd just be back to normal again. Well, that's exactly what ultimately is happening. And to your point, you're right. We tend to define the marketplace, whatever marketplace we're looking at, based on our interaction with it. And so, to that point, I'll give you an example. There's a house across the street from where I live here in Lafayette. It came on the market about a week or so ago. It was listed within 2 days. There were multiple offers on the property, and it sold, I think, I don't know yet, but it may even have gone under contract a little bit above list price. Well, it would be, and one of your agents, by the way, was involved in that. It was a great house in a great neighborhood, a newer product, and it was under $200,000. Under $300,000, and it went like that. And so it would be easy to look at that transaction and say, well, the market is just as crazy as it ever been. And I even see people posting that. Well, I had multiple offers on properties, and that will happen still for certain properties that come on the market in gap areas where there is very little to no product still available. That can still happen, but it is not what it was just 2 years ago when people were saying no appraisal, no inspections, no this, no that, because there were 10 people in line.
Yeah,
that is not the market that we have. And but I want to emphasize that, and you brought up the point that what we ought to be talking about is a market shift. That our market has, in fact, transitioned. What it has not done is it has not collapsed. There's a whole lot of difference between market shift and market collapse. If you're going to talk about market collapse in the two historical aspects of Lafayette or Acadiana, you might look at 2008, 2009, when we all thought Armageddon was going to occur for the financial recession, and you may go back to the 80s when we had the oil crash. Okay, you want to look at that? There were collapsing markets. This is not a collapsing market. This is a shifting marketplace, and it's just shifting back to normal.
Yeah, and the numbers are showing that, and I want to get to your slides to really, drill down, prove to the audience what exactly is going on. But
sure.
Before we do that, so you're a you've got a new baby on the way. You've got 3 kids. You're living in the Sage Streets, and you need a bigger house. What would you tell that person or that demographic if you're entering the market or considering entering? What would you be looking at, and what would you tell them?
Well, I would tell them this, is that is exactly the kind of drive that should be motivating you to make some kind of decision to move. That's exactly why, as opposed to, gee, I want to buy one now so that it'll appreciate 10% next year and I can sell it for a profit. There are flippers, but for the average person, it is, hey, I need something in to make my life more fulfilled, or the needs of my life fulfilled. I need to make a move. Okay, so my advice to them is, that's a natural thing, and you need to be looking to see if you can find something to fill that void. So it's time to go shopping. And my advice would be, if you find, first of all, you get qualified, so you know what you're looking for. You find something that you fall in love with in your affordability range, then you move forward on it.
Yeah.
You fall in love with the house. And what we're saying in this environment as real estate people is, what about these high interest rates? And the idea is, you fall in love with a house, you date the interest rate.
Right. Right now, that's what
that's what people are doing.
Yeah, and so, but in that, you just mentioned something that I think is the key, is affordability. If it's affordable, and what we've seen, and you tell me, since 2020, let's just say March 2020, is when the pandemic started to make an impact. to today, over those 3 years, what's the what is the average increase in prices
In average sale price?
over those last 3?
Well, I'd have to find that slide. I can't call it.
Just in general, you think?
Well, I would think that it's been double digit.
Yeah, so it's in the teens.
Yes,
probably closer almost to 20 because we had maybe 6, 8
per year.
Right. So like if we look at the last 3 years, so although I guess my point is it depends on your situation when you bought your house. If you bought your house last year, it could be a different situation as far as your affordability, what you can get. But if you bought your house in 2018 and you've now got, the interest rates are higher, but now you have more equity to make that
offset that.
To offset that price.
Absolutely valid point and very good point to make. And again, one of the dynamics that we're seeing is that although we've seen adjustments in the marketplace as far as numbers of sales down 30%, what we have not seen is a decline even commensurate to that of average sales prices. It may have gone down maybe a couple of percent. And so we were actually in a marketplace where that asset depreciation hasn't really occurred. Is there some anticipation that there's a collapse ahead and that we're going to suddenly see prices fall? I don't see it, quite frankly, because there's first of all, there's nothing out there to look to see what's going to bring more inventory in any kind of tsunami tidal wave.
Yeah, and I mean, and speaking about that, 2 points I want to make with what you just said is, there's no sign that we're going to have a huge influx of listings hitting the market because of, a lot of the listings,
right.
They have to sell first,
right,
and then they're going to be buying. So we're not seeing that delta that you would normally see. And I've heard a lot of people, I get asked all the time, like they think the world is, although it's changed, their perception, or a lot of people's perception, is that we're busting a bubble right now. And I hear it like, hey, I want to start to look at foreclosures. I want to start to look at all these type of houses, and we're just not seeing that happen because you bought a house 2-3 years ago. It's worth more than it is
absolutely
today.
Absolutely.
You still have foreclosures. That is happening, and we are working with them, but it's not the that people think or anticipating, right, because the equity is there.
Exactly. That is exactly the point.
There.
That's a major difference between 2008, 2009, when people were loading up their houses with home equity loans. They're using them as a slot machine to basically just pull cash out whenever you want. It's a credit card. Your house was a credit card.
That's right.
And so when the market shifted and there was some laxity in the market, pressure downward, nobody had any equity in their houses, and it was the standard, I'm going to mail my keys in, I'm not going to pay on a negative asset. Well, we are so different from that now. For the most part, that I just don't see that playing in as a factor. Now, what I do see playing in as a factor is that we have seen cost increases. Look at new construction. Even in a relatively down market, the costs have increased. Material costs have increased. Now, in talking to my contractor friends, I do understand that lumber, certain materials that had soared 2 or 3 years ago have come down, but conversely, concrete, piping, and things such as that have gone up. So they're still seeing pressure upward on pricing. And one of the things that the buying public is resilient, especially when it comes to housing, because as we talked about, it's one of those 3 basic needs: food, clothing, shelter. You got to have it, okay? So if they can't find the affordability, if appreciation in Lafayette Parish has brought properties to a point where affordability comes into question, what people will do is exactly what they're doing nationally. What we're seeing is people moving from Western United States, where property values are astronomical. They're moving away to more affordable areas of the country. Well, that's the same thing that's happening on a mini scale here in Acadiana, because what we're seeing is a movement more and more toward people buying outside of Lafayette Parish. And when you look at the factors that are driving that, the number one factor has got to be price. So when you see a certain segment of the population, quote unquote, priced out of the Lafayette market, you see other markets that are springing up in the Acadia Parish area, in Scott, west of Scott, in north of Lafayette, in Acadia Parish, in St. Landry Parish, and now we're seeing it, which is amazing, in this first quarter, a significant rise in the number of new construction sales in Iberia Parish.
Yeah, that's really interesting because, as prices increase and supply is still below that 5 to 6 months of supply, we're seeing people, not hesitating to move outside of Lafayette as much, as they did before, where they wanted to be in the core of Lafayette. Now, hey, if I can get a $200,000, $250,000 house in Brobridge area, yeah, and it's in a decent area, and they're much more likely to make that move today than they were 3 years ago.
Do a 20-mile radius around the center of Lafayette and see how much area that brings in. And to say, hey, I live 20 miles from anywhere. Talk to somebody who lives in Houston.
That's right.
That's living in downtown Houston.
That's right.
Okay.
Right.
We've been, I guess we're all forced to see the world from where our sights are. But if you can take an overall view of what's going on, and that's always been my philosophy as far as taking a look at these numbers, is don't get too bogged down on your street. Let's take a look at the big picture, but don't get too hung up on the big picture either. You just got to take your lenses and drill yourself down. And so if you've got housing needs, my advice to you would be find an informed agent and go out there and start looking to fulfill those needs.
Right. So what I hear you saying is, like, look, if you can afford it and you plan on being there, for more than 5 years, it's very unlikely that anything devastating is going to happen in the next 5 years. Don't go into that transaction with any fear. Do it just like you would if you needed a car.
Yeah.
You needed to buy a car. And, I talk to people who have $80,000 cars, and I ask, like, are you really concerned about losing $10,000, $20,000 in the next 24 months, but you're going to not sell your house for another 10 years?
Right.
There is no reason to worry about going into that move. But if you are moving and you plan on, you may be getting another job or you may be relocating in the next 24 months, you may want to rent in that case,
right,
to avoid any kind of loss.
Our fear of the unknown can be paralytic, and we need to try to avoid that. If the end of the world comes, it will come. Okay. If it comes tomorrow, it will come, okay? What you want is to fill the next 24 hours with everything else that you need to make your life fulfilled. And if housing is part of that, hey, this idea of there is an impending precipice, it ain't happened yet. If you can go back in time, it ain't happened yet. We've always figured out a way to provide shelter for us. It's a challenge on affordability. I get that, but there are solutions that are out there. You may have to look a little longer, or you may have to wait a little longer, but you need to be in the game. If housing is on your list in the next 24 to 48 months, you need to be in the game now, because it isn't something where you just go walk down the shelf and there's one, oh, well, I like this, I put it in there. There is a process, and that process does oftentimes involve finding what you need. It's often a process of elimination. I can't find everything I want, but maybe I'll get 7 out of 10 on this one, whatever. But you need to begin that process, and the the fear that has been stoked by interest rate and inflation and price increases and all of those things, although they may to certain degrees be real, they shouldn't be stopping you at this point, because the market has adjusted, and there are opportunities that are going to continue to be out there.
Let's talk about baby boom. That's your generation.
Yeah.
My parents are also going through this. Hey, they had our family home. It's much larger than they need. The master bedroom's upstairs. My dad's, they're getting close to their 80s. And so they're having these conversations. And, I could imagine there's a lot of uncertainty there, like downsizing and buying now and selling, putting your house up for sale, and then buying another one. What advice would you have for the baby boomers in our area that are having these type of conversations? Like, how would you help them?
Well, I would tell them, first of all, you're not alone. If you're feeling any angst because of what you're feeling, don't think that you're alone. As a member of the baby boom generation, we're going through exactly what you talked about. We have a very large house. It's an older home. We've owned it for 30 years plus, and it's much bigger than we need. And so we have gone through the banner, the examination of conscience, if you will, about what are we going to do. And we are right now exploring some possibilities of doing some renovations, because we love our house. Mm-hmm. But the other part that we go through, we affectionately call it the love it or list it phase of our lives, where we're trying to ultimately come to terms. And some of that is, well, let's renovate this, make that nice, because at the worst that could happen is, if we still end up wanting to sell it, it'll be worth more because we've made these improvements. But the point is that we're all going through that as baby boomers. The idea of downsizing, the reality of downsizing is the real challenge, and that is, I would move if I knew I didn't have to hassle with getting rid of my stuff.
Right.
And that's the biggest thing, is
so
we got this big old house, right. We got all this stuff. Yeah. So I think, one of the things we might want to explore as baby boomers is, let's have pre-death estate sales.
Mm-hmm. That's not a bad idea. My mom is like, for Christmas now, the grandkids, everybody goes over, and she literally is just giving away her
we
stuff.
We try that, but our kids don't want any of our stuff.
That's true. There's a lot, and a lot of the baby boomers, have these beautiful antiques. I mean, you've spent 30, 40 years accumulating all this stuff, and now you're at this point where you've got to consider, moving. And like 10, 15 years ago, when your group was buying another house or their last house, most of the conversations we were having were like, well, I can't buy that house because my furniture won't fit right there.
Right.
So now it's like, it means so much to them that they bought houses that fit their furniture and their things, and now they've got to get rid of it, and it's got to be a really tough.
Well, there's pluses and minuses to everything. One of the fortunate things of longevity for many of us is that we've been able to accumulate something. I bought my first house. I bought in 1974 for $13,000, and then lived in a few years, bought another house, and lived in a few years, bought another house, and I probably owned 5 houses, personal homes, right, throughout my life, my adult life time. And so we've traded that equity. We played that equity game. So I can tell you, when we're talking to young people and saying, you buy your house now, you live in it a few years, you build up your equity, you use that equity to buy up. Yeah. We've lived that. It actually works. We've lived that, but it's a long-term plan. And so here we are at the end of this. What my point ultimately is, one of the benefits, though, for this baby boom generation is we played that game, and for the most part, we're the ones that are acquiring the upper end, maybe smaller townhouses, might be a river ranch type property with high density, but we have the capital to do that.
To make that,
to make those moves. To make those moves. Or we have a property that we're living in that has maybe 100% equity, okay? Or a significant amount of equity that you literally can become as close to a cash buyer, if not a cash buyer, on your next purchase.
It's interesting, too, like what you said earlier, is that one of the big challenges that you guys are trying to overcome is getting rid of your stuff. And like we were joking, like a pre-death estate sale, but I mean, is that a thing? I mean, obviously that's something that's everybody in your generation that's in this conundrum is thinking about. Like, what do they do with their furniture? Is there a solution to that right now that people are doing that in your groups of people?
Quite frankly, I think most of them are trying to pawn it off on their kids.
Yeah, right.
And do things like that. Or even I know some people that are renting storage areas. That's the other thing. If there's things that you can't part with, okay, then store it. If you have no room for it, store it until at some point in time you're no longer around, then somebody else is going to do a garage sale. But the challenge you always have in a real estate transaction is that you put a house on the market, you're living in it, so it's hard to move out of your house in order to sell it because you're living in it.
Right.
And therein is the conundrum. Then you put it under contract. Well, the people want to move in, so you don't have that much time to dispose of everything. That is your conundrum. But there are ways. I mean, you can give stuff away. There is the Salvation Army. There is Goodwill. There are places that if you need to move, you can find it.
Just
don't let the fact that you got furniture out the wazoo stop you from making a decision when housing is really what you're thinking in.
Sure.
We can find all the excuses in the world that are secondary excuses. Well, I can't do it because of this or this or this. But the primary thing is we're talking about housing.
Yeah.
Is this where you want to be? Is this where you need to be? Is this where you're supposed to? Is this the chapter of your life that you want written? If it's not, and real estate is part of what's lacking, and let me help you do that, because it can happen in this environment.
Right.
It can happen. It is not a collapse. You have to be an informed realist.
Right.
You can be a pessimist, you can be an optimist, and not a lot of those, but be an informed realist. And that's what we're trying to do as real estate professionals for our clients.
So it's really about, having the facts, but also getting advice. And it's sometimes, and especially, in our field, it's, where do you even start? And sometimes you just need somebody to, throw out ideas to, and then get some responses. Make sure that you are on the right path and what it is. And to me, to go back to what you said earlier, I think it all starts with your equity. If you're in that situation, and you've got to start with, like, how much is your house worth before you even have a conversation of where you're going to go. Absolutely. If you have a property to sell and you have to sell it to move to the next one, because that will determine almost, instantly the price that you can afford to keep you comfortable where you want to be, no matter what the interest rate is.
Absolutely.
And, we assume that, we are moving back towards a more normalized, hopefully interest rate that's not, going up and down like crazy, but at least in a, pre-pandemic levels. Hopefully it looks like that's the path that we're moving towards. But
yeah, and again, I think that we became kind of intoxicated with the idea that interest rates below 4% were real, because they were for a decade, but they're gone. And everyone who has any knowledge, financial knowledge, or economic knowledge knows that what has happened during that 10 years, the reason those interest rates were as low as they were, for the most part, it was manufactured. It was stimulus. And we've paid the price for 10 years worth of stimulus. Nobody knows for sure anything, I guess, except God. But if I were to ask to predict, I will say you will never see 4% interest rates again. Not in my lifetime, but I'm old. Not in your lifetime, you're a young man. Or not in the couple that's buying their first house. Okay, and most of the people who are buying first-time buyers, in my dialogue with them, the idea of a 6% or a 6.5% interest rate is not something that's shocking to them because they didn't have that 3% rate. Okay, it's more of a challenge of understanding how that impediment can be overcome for a seller who's got maybe 70% coverage of his value of the property or her value of the property is indebted. Right. 3% or a 4% mortgage. That's the person who has the conundrum, not the first time 21-year-old.
I mean, first time home buyer, your choice is either rent, and in most cases, you could still buy right now with 6% interest or 6.5% interest cheaper than you can rent.
Well, here's the other thing, that they understand what 24% interest rates are on credit cards.
That's right.
That's what they're comparing this to.
So that's a no-brainer. If you're a baby boomer and you probably have equity to power the move to your next house and you could sell your house, but you brought up the demographic that is having the biggest challenges, whether they bought in 2021, 2020, 2021, 2022, or they refinance their house. That is, now they're at a, 2.7% interest, a $300,000, $400,000 house. What would you say to them about, their, entering the market right now?
Well, if they were high leveraged, first of all, if they're high leveraged, they don't have equity, then they have to be high earners. And the real question is going to be, well, we got to look at what your earning capacity is relative to what you can borrow, and what does that look like relative to what you're in. And assuming you can borrow more, it's going to cost you this. What's driving this? Is it the house that you wanted for 40 years has suddenly come on the market and you want it? And this is all you've ever wanted in a house, and it's suddenly there, and you want to take advantage of it. You call me up and say, how can I do this? And I say, if this is what your fulfilling need is, then you stretch every way you can to get it. But it's going to be challenging. Now, if you're sitting there with 50% of this 300,000 plus asset is covered by mortgage and 50% is equity, now it's a different whole ballgame. Okay? So it really is that discussion that needs to happen. It's the conversation that has to be initiated. And so if there's any message I think that we want to get out to the general public today is don't let what you hear stop you from at least conversing, exploring. If within your lists of needs, there is housing that is part of that consideration, you need to be having that conversation, because the circumstances that we're in right now is not a prohibitive necessarily to you having a home ownership value and have that same wealth building that has occurred for generation after generation after generation occur again.
Right. And even in the past and you've experienced 40 plus years of market, transitioning into, every market that we've had. I know ours is a little more unique than you've seen, but even going back to 1984 and 85 when, everybody left town,
right,
in Lafayette, and you had a different situation. Plus you had super high interest rates back then. I mean,
yes.
double digits, and it, in some cases,
Right.
looking back in the long run, if history does repeat itself, I mean, there's even back then at 10% interest, there was reasons to buy, and it was still, if it was affordable, you did it. But every generation, every type of home buyer, at every time period, you never at a place where you're like, oh man, this is a really good deal, the prices are really low. It always seems to be, looking back the last 20 years that I've been in it, that people have always said the prices are too high.
Sure.
But when you look back, you're like, man, I wish I would have bought 10 of those properties at that time.
You're absolutely right, because we're myopic in the way we look. We're ruled by the constraints of what we see, okay? So what I mean by that is people, as they do you, I have people call me and say, well, I'm doing a story on the high cost of housing in Acadiana, which are your comments on that. And we go through that same thing. Hey, it's all relative. Back in, if I own a house in San Francisco right now, and I'm selling that house and moving to Lafayette, Louisiana, and I buy at the most expensive house in Lafayette, I'll bet you my statement as a San Francisco person is, your housing over here is so cheap,
right.
Okay?
That's
it's
right.
all relative,
It is,
okay?
yeah.
So when we go back into the 80s, yeah, you're absolutely right. One of the regrets I think most of the survivors of the 80s have was that nobody who was in Lafayette had any money left. And so the money that was made was outside money that came into Lafayette, bought up old subdivisions that were half developed, bought up office buildings for pennies on the dollar. There were a few people in here that made fortunes because they were willing to invest or had the capacity to do it. So more people have lost more money by being negative about taking advantage of opportunity than clearly those that have taken advantage of those opportunities.
Sure. Well, we spent about 32 minutes on the intro, so let's see if we can support some of this thing. But
That's what editing's all about.
I think it was great, man. Like, the fact that we have these different demographics looking to come into the market, and we always talk about the numbers, but we rarely get a chance to spend time to like, what does it really mean to each type of buyer that's coming into the market? So now that we've kind of gone over, we talked about, first-time home buyers. We talked about, people who are moving up because of their families are growing or jobs, they got a higher salary. We talked about baby boomers. And we also talked about the buyers that bought or refinanced, the sellers that bought or refinanced in during the pandemic and are at a 2.9% interest rate on how they should be coming into the market. And I think it all starts with conversation.
Right.
Really don't be afraid to have that conversation. It's okay just to talk. By talking about it or conversing with a real estate expert, you're just going to gain more information for yourself to make the decisions, right?
If you're talking to a professional real estate person, they're in the game for the long haul. Real estate is a long-term asset, and so we know how to play in that environment. And so it's not the idea that when I have a client talking to me, it is for me to give them, as we've said, advice. And the decision may ultimately be, this isn't the right time. It doesn't play under your circumstances. But you will never know unless you have that conversation, because typically the average person doesn't have the information. And so I stress this our whole talk. I want people to be informed realists. I want them to know about the market, what reality is. Again, you can hear the noise and you can formulate from there, but the reality is what we want, informed reality, and you can only get that by sitting and talking with a professional real estate person as it relates to real estate assets that you may have. And so I would encourage that. I really would.
Well, let's talk about the state of the market and actual numbers.
Okay.
You want to give us a rundown over the last quarter, like what we saw and where it's coming?
Well, if you just kind of in the intro, if you move to page 6, that's where we've been. This is where we've been, and what that little graph ultimately shows you goes back to the 1980s. These are the real estate sales that have occurred over that close to 50-year period of time. And one of the things that becomes obvious is you can see the big dip in 2008 when we were into the financial crisis, and that's the one that stands out the most graphically. And you can see that what happened, there was a buildup before, and then there was a correction in the marketplace, and then we had several years of basically flat market, and then we had the big rise that came post of Great Recession. Mm-hmm. But again, during that period of time, the Fed never took their pedal off the metal. They've been having low interest rates. They've been involved in quantitative easing all the way back to that 2010, 2011 period. And then you have, again, basically a flattening off as we had, which is kind of a cyclical thing that we've experienced. And then you have your COVID years, and you can see how things just went totally bonkers. We went from 2019, where we had 5,600 sales in the first quarter. No, not in the first quarter. In the year, and by 2021, the height of the craziness that we were going through, that jumped to over 7,000 transactions. That's like 5 years worth of growth, 6 years pushed and compressed into 2 years.
Right.
And so we came off of that, and as we said, everybody knew this was crazy, and so we had our corrective year in 2022. But all we gave back was about 30% of the overall gain that we had. It was the full 2021 gain, but we still weren't back to 2018, 2019 levels. Last year, for the year, I think there was about a 13.6% decline overall. And that's when we forecasted, okay, we gave back all of what we gained.
Right.
Now, but we still got to give back 2020. And so we're going to do that. And we predicted that's going to take another 14% decline. And that's when I said, well, the problem was at the end of the first quarter, it was a 30% decline. And that's what the next the next slide shows you here on the bar chart, what we did for the quarter relative to where we were last year for the first quarter. But remember, we prefaced everything when we started this conversation, was what we forgot when we went into this year was the first quarter was when the market was still crazy.
Sure. Yeah, the interest rates didn't start to rise until end of February.
Yeah. And so you see us here going up, and here's your 30% gap. This gap right there. Okay. But where is it going? Well, we've got one more big month of sales that'll be challenging for us, which will be what? May. And so clearly by the end of the first half, we'll know a heck of a lot more where this market is going. But my predictions are that it's going to probably do something like this, and that we're going to see this kind of stuff. Yeah. Right. But if you look at this line, we had in December of 2022, we had a big dead cat bounce. At that month of closing, and there was at the end of 2022, there was a little period of time where there was a shuffle at the end of the year to lock in rates because rates were going up, and so we saw Actually, this would have been contracts that were done maybe in October, November, but that closing. And then it dropped like a rock, because if you continued on, this would have been the next number of the next month. Down to here. But we're back now where we're above that number.
Right.
Okay.
We're above where we're in December.
That's exactly right. So what that shows me is that, yeah, we're down 30%, but if you look at where we are quarterly and bring your hand down, where does it ultimately show where you're equal to? And you're looking at basically the average of 2019, 2018.
Sure.
Which is, again, what we said we thought things would go.
And so that was sales.
Right.
And volume is...
Dollar volume, go to page 5. Dollar volume, basically page 9. Okay. Dollar volume basically did the same thing. As far as graphically, you can see it's similar. It's just that one of the things that we saw in the buildup of sales was that dollar volumes went up at a higher percentage than the actual numbers went up, and so you see almost 58% gain in the 2 years following 2019. And then last year, where we had a 14% decline in sales, you had only a 7.6% decline in dollar volume. Again, telling us that we've seen we see our real estate assets are not collapsing. Okay, and as the slide says, at the end of 2022, we forecasted a decline of only 12% in dollar volume. So we had a higher decline, 14% units, 12% in dollar volume, because again, we did think there would be more erosion of price than actually has turned out. But that decline, we had forecasted we would have another 12% this year. Or about $1.4 billion. And in fact, the next page, we see that much like the units, there was it wasn't quite 30, it was 29.8% drop off. And so we've seen almost $275 million plus $1 million in closed sales that occurred. But when you look at this bar number, it is a significant drop off. Right. But where is it? It's not at 2018, 2019 levels. It's actually more in the 2021 level or 2020 level.
2020. And that's because our average sales price has increased significantly over the last couple of years.
Average sales price right there. And you're right. This shows you the average sales price for the first quarter of this year, okay? But it's comparing it to the average sales price for the whole year.
For each year. So
this year.
This average sales price is just the quarter.
Right.
Date.
If we were to use the average sales price at the end of the first quarter of last year rather than the end of it, it would be actually the average sales price would have increased over the first quarter of last year by about 7.4%. About 0.75%.
So yeah, and I think that's important because this is based off the whole year, but as compared year over year over the last decade, we're still higher than we were last year.
Absolutely.
I think that's important.
And then
which is driving the increase in the volume. So although our sales are down, our volume is
is not down as much. Okay, and again, that equates to average sales prices. Now, what's the impetus that's driving this sales price stability, if you will? And the next page basically spells it out. numbers of new listings. And so you can see first quarter numbers of new listings this year are off about 17%. This is last year, they were off about 9%. So we have increasing percentage of drops in listing from basically 9% last year, first quarter, 17% drop.
And so this is why, what you said earlier, we were expecting a much higher drop in volume, but we didn't see that because the inventory is staying so low.
Right.
Which is, it's just keeping that, even though our demand has significantly fell, the new listings coming onto the market the supply is so much lower than we would have expected to see. And I'm guessing that's as a result to people in these super low interest rates, considering to sell and put their house on the market and then turn around back. Well, that's what they may just be pausing.
In the beginning of the COVID period, let's say 2020, and there was probably some angst or hesitancy on the part of sellers to just, how do we do this in a pandemic environment? People traipsing through your house, that kind of stuff. It was difficult.
No doubt.
And I think that impacted people putting properties on the market. But that being said, if you look at the general trend of new listings, the last few years it's been more erratic. But we say we've had a chronic shortage of inventory, and to a certain degree that's the case. But it's been caused by the demand aspect, not so much, at least getting up to here, this point in time. It wasn't because we were drying up with listings. That started coming actually in the 18, 19, and those periods of time. So to me, the idea that we're having more flexibility in what's out there is a good thing, and it's directly related to the drop in the demand, not in an increase in new listings, because that's not happening.
Right. We're not seeing new listings coming on the market at the same rate that we would have expected over the last decade. Like, we're just so much lower. In fact, you had told me last week, you would have to go back to 2004 to see the same number of listings coming onto the market.
Right.
That we're experiencing.
That was before the end of the year, but I ran the numbers again now that I've got the first quarter in. And actually, there were 1,630 listings as of this morning that were in the first quarter of 1,638 of this year. You'd have to go back to 2013
to see
to get that. This is all throughout Acadiana. Now, if you're looking at Lafayette's parishes new listings, we had 908 new listings for the first quarter of this year. You'd have to go back to between 2012 and 2011. 2012, we had 979 new listings. 2011, we had 867. So it's somewhere in between there. So the level of listing activity is much more acute in Lafayette Parish than it is overall throughout Acadiana.
Yeah, and so that's what's really going to keep. It's supply and demand is going to be the price, how the price is going to be adjusted, and we just haven't seen the supply that we to fill that demand that we have. Even though our demand is lower, we still have more demand than we do supply, I guess, is the summary right there.
Right. Now, one of the things that you will obviously, if you go to page, 48? That the trap, if you will, that you can run into in all that I do and all that we've been talking about. That trap is that these are all sales. And sales are post-market activity. That what I mean by that is
indicator.
It's a lagging indicator. These sales were actually buyers that were buying when they went under contract a month or 2 months ago.
Right.
So one of the things we want to look forward and what we've shown so far, I hope our listeners get that, is that trajectory, that nice, good trajectory that we predict will eclipse at some point 2022's numbers, and that's where we'll get that crossover later on during the year. How confident are we that we will get that? That's where you look at what's happening with pending sales, and that's what the next few slides that I think are going to be real interesting. First of all, this is what's happened on pending sales so far, and one of the things you can see is, again, that February to March pending sales really close. I don't want to say close the gap, but darn near close the gap. And the other thing to point out is that March of last year was the single highest month for pending sales in all of 22, as you can see on the red line. It only went down after that, and we are going up.
Yeah.
Okay. So what does that portend? Well, we didn't quite make it here, but if we can keep this momentum going, I could well see crossover occurring in maybe just a month or so.
Sure.
2 months.
It could be, April or May, with the normal seasonality, whereas last year we started to see that decline through the summer, which is typically our higher months.
Right. Right. Another interesting point, and we've kind of touched on this already, year to date, okay, the amount of pendings are down overall 18.5%.
And that's from this right here.
That's correct.
And
overall for the quarter.
Yeah.
Okay. But outside Lafayette, they're only down by 0.7%. Which, again, it goes to that but the observation that we've made that there's more and more activity that's occurring outside of Lafayette Parish.
And that's because the average price outside of Lafayette Parish is, what, $70,000?
About $50,000.
$50,000 less than Lafayette Parish.
Yeah. So that shows up in the next slide is Lafayette Parish. And now you can see these are pending sales. That the gap on pending sales relative to last year is wider than the overall, meaning that there's more intense activity in that outside Lafayette Parish, relatively speaking.
Well, and the thing is part of this is absolutely the inventory, lack of inventory. We have buyers now that are ready to pull the trigger.
Right.
And just like you had said about your house across the street, how it had multiple offers. I mean, some neighborhoods just have no supply.
Right.
And so if we would have had more supply, we absolutely would have had more sales in Lafayette Parish, but we just don't have a lot. And that if you live in G1, G2, G3, or, East Bayou Parkway, West Bayou Parkway, Say Streets, that whole area, there's just not a ton of activity.
Right. And that's somewhat reflected here also, because if you look at the year to date, the pendings are down just under 28%. Existing homes down 32.5%. New construction pendings are down 15.2%. So clearly, existing homes are the gap in our inventory. The next slide is the overall pending dollar volume and for all of Acadiana. And you can see that last month that the March pendings were up 24% from February.
Yeah, let's say you jump right here.
Parish dollar. Next slide for Lafayette Parish. Again, pretty much the same story. And then we can just kind of go through some recap of things, and that may spur some more conversation. So overall, these are the first quarter numbers for all of Acadiana for 2023 versus 2022. So you can see we're down about 30% in units, down just under 30% in dollar volume. Average sales price is up 0.7%. There's no change in the median sales price, and the number of new listings reported are down overall 17%. Next slide is Lafayette Parish. All sales, meaning it includes existing and new construction. And you can see here that the total number of sales are down 38%, dollar volume down 36%, average sales price is actually up 3%, and the median sales price up 1.3%. Next slide breaks this down into existing.
But this is what's, number of new listings reported, we're almost 30% less.
Yes.
And I think that's the reason why we're seeing these average prices still go up with a high interest rate environment.
Absolutely. So when we look at the existing homes, now the numbers are more all red. 38% down, 38% down in volume. The average sales price is about equal where it is, down 0.2%. Median sales price down 1%. And new listings on existing homes down 27%. And then the next slide is new construction, down about 38%. Dollar volume, though, only down 31%. And that's not contractors wanting to put more and more money in their pocket. That's a direct, from what my feedback is, direct reflection of actual cost increases.
And I don't even think that covers the increase in cost.
Probably not. And one of the things, again, we're seeing is more new construction that's happening outside of Lafayette Parish. And again, the thing that's driving that is going to be price, primarily. Land cost development requirements are significantly more affordable in outside Lafayette Parish than in Lafayette Parish.
So real quick, new construction is one thing we didn't really hit on, but if you're a builder right now, what does this data tell you?
I had some information on the new construction. Let me find that page, but I might close around. And that kind of dovetails in with wait, right here. Page number 18.
All right.
Okay.
Yeah. So the information that you provide is now really about, like, if you're a builder and you've done really well over the last few years, your prices are increasing, your margin, your price actually that you're selling your property has increased about 8%. But I've heard that some of the material costs, even though lumber's come down, is still 15% or even more in some cases. So utilizing this data, what would you tell a builder who's thinking about building a spec home?
Well, I would tell them, first of all, take a look at how crowded the field is at that particular price point, if you're building in Lafayette Parish, because we do have breakdowns of particular price points and what's selling in that. And what I would tell you is, back in the COVID years, and when things were nuts and the interest rates were down, there was a lot of transition of builders into the 350 and up range, because people who might have been buying a $275,000 new construction were now looking in the 340, 350 range.
Well, and I think the average new construction is close to that, right?
That is
yeah. So I mean, the average price of new construction is
average.
Yeah.
So there's been a lot of movement of builders into that, and that's where you got to watch, because things are going to get crowded in high cost inventory. Now, the other side of that is we're seeing a lot of new construction that's happening outside of Lafayette Parish, a significant increase, which is what this slide reflects. There were 261 new construction sales reported throughout Acadiana for the first quarter, totaling just under $80 million. Last year, there were 353, totaling $99 million. So there's been about a 26% decline in sales and about a 20% decline in dollar volume. But here's the kicker. Of those 261 new construction sales reported for the first quarter of this year, 84 of them, totaling $22 million, were outside of Lafayette Parish. Okay. Last year, there were, 66, about 16 million. So there's been a 27% increase in the sales of new construction that are occurring outside of Lafayette Parish, and about a 39% increase in the dollar volume of sales. That's telling me that there's a market that's moving outside of Lafayette Parish. Okay. The problem that presents, though, for the traditional stick builder in Lafayette is that most of this product is being put on the ground by your high volume builders, DSLD, D.R. Horton, New Century Communities, and those entities. And so it's much harder to compete as a stick individual builder against these high volume operations, regional type builders. But that is what we are seeing as far as the general public's embracement of new construction. It seems that they have no problem in buying new construction that's located in Maurice, New Iberia, or places such as that.
So if you're a local builder and you're looking at this data, what would you do? Would you say focus more on the outside of Lafayette Parish, or stay inside of Lafayette Parish where there's not as much inventory, or there's less inventory at higher prices?
I think it's going to, you're going to have to be creative. I think builders they're going to be the frontline people. They always are, taking it on the chin in a shifting marketplace, because they are always setting the highest standard as far as value is concerned, because it's new. Always going to be that way. And they're going to have to ultimately take the brunt of what we're facing in this market shift, which is the cost of capital has gone up, and that is creating a shift as far as buyer demand and buyers' wants.
So, I mean, what would you suggest, being more diligent and are trying to being lower? And this is why I'm asking is because, if you look at just the months of inventory and sales at different price ranges, it's misleading.
It is.
You have some, if you look at between 800 and 900,000, looks like we've got no inventory, which we actually don't. But the number of sales that are happening are so small. You know what I mean? So but then you go from 900 to 1 million and you have a lot more. Then 700 to 800, you have a lot more inventory. So that would tell me usually I want to be in the $800,000 price range.
Well, when we look at, advice is something, when we talk about giving advice, we said, sometimes that advice is not going to be maybe what you want to hear. Well, when I look at new construction in Lafayette Parish and not numbers of months supply, here a couple of things that stand out to me right now. Active in the $300,000 and up. There were, in Lafayette Parish, there are 194 active listings. Last year at this time, there were 111. So it's gone up by 75%.
And, that's a lot. That's also like when they get into the business or into that house, that construction it's a lagging indicator of what happened 6 months ago.
I get that, but the demand side, the supply side's up 75%, demand side's down 22%.
Going the other way.
So another way of looking at this, those 194 new construction listings that are 300,000 and up represent 59% of all of the new construction listings. Almost 60% of all the new construction listings in Lafayette Parish that are on the market are above 300,000 or 300,000 and above. Okay, there's of what's selling 300,000 and above new construction, 37%. So you got 60% of your inventory is on the market, and you only got 37% buying it.
Right.
Okay. Conversely, let's look at the 150 to 250. No, 299. 150 to 299. Now most of that's 200 and above, because up until 180 you don't have anything as far as sales. But that's where 63% of all the new construction sales first quarter of this year are in that price point. Say, let's say 190 to 190 to 299. Okay, listings, there's 40%. So there's an imbalance. There's a 3.6 month supply of product in that mid-range, more demand than there is supply. There's an 8.8 month supply in the 300,000 and above. Much more supply than there is demand. Not in all price points, but in many of them where we have 12, 18 month, 42 month, 28 month supply of product. Okay, what kind of advice can I give a builder who's got an inventory sitting in a price point where there's 42 months supply of product? I'll tell him, hold on.
Yeah.
Okay. But if you are paying interest on this monthly, you better find a way to do something. Either you cut your profit, get out of it, or, look at maybe some alternatives of renting to pay your note. There's not a lot of good alternatives.
But don't go out and try to starting specs. I mean, if you got a custom, which we know there's a lot of custom homes going up, that's a different story. But if you're thinking about getting into another build, really look at the numbers and have that meeting with an expert before you jump in. Because you and I have talked about this a lot, and some builders seem to just follow other builders no matter what the numbers are saying.
Sure.
And sometimes they just get lucky.
Yeah.
There was times in 2018 and 19 I was seeing that happen. I was like, man, I don't know about that. If I'm a builder looking at the numbers, I don't think I would be building in that price range in that zip code. But who would have known? Pandemic happened, and we had such a shortage of supply. They really dodged a bullet, in my opinion,
right.
In some cases, and it was just luck. But I do see it a lot where, so-and-so is building in that subdivision, so I'm going to build in that subdivision, and it kind of creates a frenzy without anything to really back it up.
Right.
I guess.
Now, the challenge going forward, some of this stuff is off the spectrum of just real estate, but a couple of things that do come to mind that I've been hearing is that with these bank scares that we had recently that sent ripples nationally, that what the ultimate result of that may well be that regional banks are going to become much more stringent on their lending requirements. It is those regional banks that lend money to builders to build, lend money to developers to buy property and develop properties. So one of the concerns that we have looking forward is how restrictive is it going to be in the future for builders to build? And what kind of challenge is that going to ultimately present? But builders are resilient people. They've been through these times before, and I know in speaking with a few of them, they're preparing for alternatives of survival, which includes a lot of them getting into the renovation game. We talked about that, and maybe that's a basis for more conversations with your real estate professionals as a builder is to say, look, I may want to expand out into renovation. When you're having conversations with your sellers and they're in that dilemma of what do I do, maybe I can get you two together and start getting a financial picture of what is this going to look like if you do the renovations. And then we keep our builders happy and employed and for the next round of craziness, whenever that'll happen.
Well, but just to summarize that, it sounds like what you're saying is if you can build a spec home, if that's your game, and you can build it 300 or under, that's what you should probably focus on for the next few years.
If you can do that.
If you can do that, we know that prices have increased, so the margins are smaller, but
right.
That's a no-brainer if you're looking at the data, which, we know that that's not everything, but if you're looking at these numbers, it's apparent that 300 and under is really where it doesn't seem like there's any risk.
Yeah.
300 and above, you really need to start looking at each individual area, each neighborhood, each price range, because in general, it looks like we have more supply than what we have demand, or the ability, the buyers to absorb the supply that's coming up in those higher prices.
Absolutely. And another thing too, that I was driving down Congress just this week and noticed a local builder, Emmanuel Homes, that has a little corner piece of property, okay, which is doing a high density building.
Emory and is it Emory and Congress?
Yes.
Yeah.
Okay. I thought that's quite innovative, and that we need to do more and more of that, because the cost of one of the things that we've seen that has been I think has been to a certain degree a negative to new construction, is that Lafayette has built itself outward to the periphery. So most of your new
sprawling out
or new subdivisions where the buildings occurring are on the cusp of Lafayette. Well, if you're right there on the borderline, what does it take to go, a mile further and get $50,000 to $75,000 worth of difference in value? Okay, it's not a bunch, and so that's another thing that our construction has pushed to its limits. We need to do more infill. Infill because you already have all the infrastructure there. Infill because you don't have development cost of roads and streets and that kind of stuff. It just makes total sense. The problem that we have is the NIMBY factor that we've always had to battle that idea against, and that is, I love the idea of what they're doing on Emory, just don't do it across the street from me.
Right. Not in my backyard.
Not in my backyard.
Man, that was amazing. We blew by our time limit tremendously today, but I thought it was great information. I love the conversation, all the data. In summary, what would you say based off of where we are today, and what does our future look like at Lafayette?
I'm upbeat. I am. I've said this time and time again over the years. Lafayette has always impressed me as an entrepreneurial city that is resilient. We're resilient and we're dynamic, and that I know we don't have the oil industry that we had in the 80s, but I went to the commercial alliance presentation the other day, and one of the most pleasant things was there were 3 or 4 chief executive officers from companies that are outside of Louisiana that have moved to Lafayette over the last 5 years. And across the board, they said that the environment that we offered, although it took them a while to discover it because we're just a little tiny community, but once they came in and saw how dynamic and how entrepreneurial our community is, they found that this is where they want to be. This is where they can expand their business, and that says an awful lot about Lafayette. I've always said real estate is a major part of the economy, but it's not the driver of economy. It is the economy of wherever that real estate is that actually drives the real estate economy. If you're in a dynamic community, you're going to have a dynamic real estate market, and you're going to have a sustainable dynamism. It's going to, it's something that isn't a one-night wonder. And we've been through our downs, but the one thing I can say about Lafayette, 50 years worth of living here plus, is that it's always come back. It always has. And the other thing is we've always loved our real estate here in Lafayette.
Well, I think that's it, man. Thank you so much on behalf of everybody and all of our clients and all of our agents. Thank you for sharing this data with us. That's a wrap. That's the fact.
The wrap.
Facts by Bill Bacque.
Lafayette, let's talk.
Hello.